take you to the markets. We are mixed. Dow is lower. Everything else is in the green. We're reacting, of course, to those new tariffs. The president says they're not going to change, and there won't be any extensions either. I don't think Wall Street necessarily believes that because the S&P is still in positive territory. So, to my point, here come the strategists. David Kostin, Goldman Sachs, raises his S&P 500 valuation and return forecast for 3, 6, and the next 12 months. 3%, 6,400, or 6 months, 6,600, and 6,900 is at the top end there. So that's what you get from David Kostin. Savita Subramanian raises her target to 6,300. It was at 56. Brian Belsky, you raised your target to 67 a couple of weeks ago. Is that the proper thing to do? Never mind the tariffs at this point?
Well, thank you. Good afternoon.
Great to have you.
Hey, thanks so much for having us. I love how I say that. Congratulations to my former colleague, Savita, for raising your target. Congratulations to David as well. We love both of their work. Welcome to the rally. I would say this, that from a longer-term basis, I think they're right. I think, they both have different constituencies who they talk with in terms of their different firms and things like that. But I think it's par for the course right now, especially given the fact that many of their clients on the institutional side have missed this rally, quite frankly. And so they probably beginning to receive a lot of pressure to change that and be like everyone else. But at the end of the day, I think the bull market is very much alive, and it's par for the course to be raising after the market's already up. Okay.
Jenny, you agree with that? Bull market is here and well? Because you've been kind of a doubter at times of that.
Yeah, it's tough. So here and well, yes. And I think
it hasn't been that tough. For most.
Okay.
I'm saying, what's tough about it?
Do you want my answer?
What? Yeah, go ahead.
Okay, so what's tough about it for me?
I'm trying to figure out what's so tough about.
What's tough about it for me is the following.
What?
It's tough to doubt.
It's tough to be a doubter.
Well,
that's what I meant.
That's what he meant.
That's what I meant.
But not really, because as we've established many times over, just because I'm skeptical of the bull market doesn't mean that I'm not fully invested. The market commentary is the market commentary, and then how I manage the portfolio is different. So when you say it's tough, and I'm like, is it? I'm enjoying making money just like everybody else in a bull market. But
I know, but what prevents you from being a bigger believer at this point?
Because how can you be a big believer when you see that estimated earnings growth is declining? There's massive uncertainty out there. The tariff situation isn't great, and there's still a lot of ambiguity. We know that supply chains are going to be messed up from that, but we don't know how. We don't know how inflation's going to be impacted yet. None of these things we know. And by the way, the market's still pricing in a 22 times multiple, which suggests clear sailing and perfection. So I think where we stand on the market right now is that it's pulled forward a lot of growth, and it's assuming a really wonderful scenario. So my apprehension on the bull market is that people are expecting more than they're going to get. And when people's expectations become misaligned with what really happens, they behave badly. So if you can sit in my shoes and say, hey, great, we have a lovely gift of the market being up 6.5%, and I'm being realistic about what's going forward, maybe you behave well. But if you're sitting here thinking, hey, I deserve to make 20% a year because that's what I deserved the last couple of years and that's what a bull market means to me, then your expectations get messed up and then you start behaving badly. And that's when there's wealth destruction and problems ahead. So I'd rather, I've actually worked on an analogy, which I'll probably screw up because it's the first time I'm trying it.
Well, if you worked on it, I hope you don't screw it up.
Well, we'll try because you know me, I don't really know sports. But I was thinking about it over the past couple weeks since we talked.
Okay.
And you know how you were giving me a hard time about being so negative on things and considering all the negatives. I think it's like a football coach who comes up with a great play. And they say, if everything goes well, this play should work well. Right. But they don't then only look at all the things that should work well. They look at all the things with that play that could go wrong. And they say, if this goes wrong, we'll do this. If that goes wrong, we'll do that. That's how I am with the market.
Yeah, but they still run the play. Sure. And if it doesn't work, it doesn't work.
And guess what? A fully invested portfolio, which is what we have at Gilman Hill, is still running the play. But you consider all the things that could go wrong. And that's why I'm always kind of coming with a negative stance.
Understand. So I guess the problem.
But I can't get excited. I cannot get excited with net earnings growth, lack of clarity from tariffs, the Fed chair getting the daylights beaten out of him on a regular basis, interest rates that even if they cut the Fed funds rate, longer term rates might not go down, valuations that are kind of stretched. Like, to me, nothing about that is exciting or compelling. Still fully invested because the smart thing to do is ride the market up.
Makes sense. I think we all
like my analogy.
We all have different strategies on
it. It was well thought.
We all
well worked on. Right? I hope we didn't spend too much time working on it, but nonetheless, you delivered it well. Delivered it well.
We all have different strategies on the desk. Maybe the frustration that you're expressing is that your particular strategy in the first half of the year didn't work. Doesn't
Actually,
mean this.
It did.
Well,
okay, but go ahead. Go ahead.
In the second half of the year, I think the question becomes...
Joe just stepped in it. He doesn't fully realize
no. Go ahead.
Well,
he did.
Anyway, please proceed before you get...
But you're focused more on a dividend strategy, correct?
Correct.
And overall, maybe you outperformed the dividend strategy, but dividend strategies in the first half of the year we're not in favor.
Fair enough.
I think the important thing that I'm seeing the early days of July and where the market is today is thinking about where the market will reward the investor in the second half of the year. Because so far, the first couple of days of July have been somewhat frustrating. You're seeing it again today. The momentum names are selling off. The market is moving away from leaders. The market is gravitating more towards laggards. And the laggards are where the sentiment and the positioning doesn't really reflect the bullishness that we're talking about here at the beginning of the show. Healthcare higher today. Biotech higher today. I know myself personally, all I really have that's participating in that is McKesson, because that's been the one name that has the momentum and is trading to a 52-week high. So the market in the early days of the second half is seeing something. Maybe it's seeing what's going on in the bond market. I asked the producers back in New Jersey if they could show this chart. If you look month to date what a 10-year Treasury has done, we've seen about a 25 basis point spike in 5 trading days. That's a lot for the 10-year to move that quickly. You had overnight, you had Japanese bonds, you have German bonds, the long end backing up. So maybe the market's getting uncomfortable with the bond market once again. I don't know. But there is something in the early days that's kind of frustrating the investor who in the first half of the year was rewarded for being in the right place, because it doesn't feel like that today.
Well,
Scott, you said the market...
It depends on why, like the Treasury Secretary would say, and I think he did say as much when he was on the network in the last handful of days. Maybe it was before the holiday, where they're not that concerned. Maybe the Treasury market is just reflecting the better growth that they're banking on from the bill getting passed, not a result of any bond market anxiety over the level of the deficit.
Yeah.
That would be their response, because I think it was.
But it's not specific to the U.S. We're seeing a backup in yields around the world, and you're not seeing the type of growth that you're getting here in the United States in some of those areas where you're getting the backup in yields.
So maybe Shannon Jenny's correct. I mean, earnings estimates have come down a lot, right? Q2, 5.8% estimate. It was 10.2 on April 1st. Before the big board of the big numbers came out at the White House and scared everybody in the market. You do have fewer stocks hitting new highs outside of the S&P 500. That's being talked about today in some of the newspapers and some of the reporting. Lower quality names are the ones that have really ripped, like the meme stocks, the FOMO stocks. The ARK Innovation Fund hits a new 52-week high today. Plays into that story. What about that? What about that? Maybe people are too complacent to the risks that Jenny gave you on the list that she read off, despite the fact that we're at new highs and you have strategists raising their targets.
I think that there's a fear of complacency, but I think the other thing to think about is that if you were looking for catalysts in the second half of the year, I think that there are clearly 2 that you can point to. One, a lot has been made of the big, beautiful bill and the impact on, personal taxes, no tax on tips. The pro-business portions of that bill can actually be pretty transformative. And Scott, I would point to the fact that, capital expenditure and an acceleration of that really speaks to our view that we're going to see a global inflection higher in global growth from an industrial perspective. And
okay, so you're bullish.
So I would say we're constructive on equities. Yeah, I mean, right now we're overweight global equities. We're neutral large cap. So just to be clear, we're neutral large cap because we think that there is still some vulnerability in some of the tech names.
Oh, hang on a second. How long have you been neutral large cap?
The whole time. the last number of quarters.
We missed the whole thing then.
No.
So it's been a large cap rally.
No, we were fully invested in large cap. We weren't overweight in large cap. So we're fully invested in large cap. And we went overweight in international, so we benefited from that.
Okay, fair enough.
And we've been overweight in small cap, which has detracted, which we still remain overweight in small cap coming in the second half of the year.